In this lesson, I'm going to share with you two things that you will eventually start to notice happen in the market on the chart. This is gaps and slippages. Now, I first want to go through gaps. Now, as you can see, a gap is a gap in the market. Now, if you go back to candlesticks, by now you should know that once a candlestick opens, it'll fluctuate depending on what time frame you're using, and it'll close. Let's say an hour time frame. So you'll have an hour candle that will fluctuate within an hour. Once that hour has been completed, that candlestick will close, and generally once that candlestick closes, the area where that, or level where that candlestick closes, the next candle will then open. As you can see on majority of these candlesticks in this photo, where the previous one closed, the next candle would open. However, you'll see there in the middle, okay, circled with purple, there's a gap. Okay, now what is a gap? What does it mean? Now, a gap, like I said, is an area on your chart where there is a space between two candles. Like I said, generally once a candle closes, a new one will open there, but not with a gap. A gap is where the opening of the next candle opens either below, okay, or above the closing of the previous candle. Gaps can occur unexpectedly, right, due to numerous of reasons, such as it can happen over the weekend, so with all the orders happening on a Friday, and then you have the market closed on the weekend, and then Monday comes. Generally, once the market is open, a gap will form. Then you have fundamentals like big news announcements or news events or news reports because there's so many trading happening in a specific time, and big positions, because majority of people are trading big banks, and the big players are trading when this news event comes out. So a gap occurs, right? So those are the two main reasons why gaps occur. Now, it's less common in a currency market, so Euro USD, GBP USD, etc. Because the currency market is 24 hours, 5 days a week. So like I said, the market will only close on a weekend, whereas like stocks or whatever, it might close at night, or whatever else there is out there. So you'll tend to have more gaps in those sort of markets. A gap involves where there is no trading in between. Hence, there's a gap. Okay, there's no price. Now, a gap happens after news events because of the volatility, like I said. A gap happens after the weekend because the market is closed for us retailers, but it's open to central banks, so that makes a difference. So you also get different types of gaps. First one is your common gap. This is where price is gapped, Small section, there's a gap. There's like an opening space. Second one is a breakaway gap. Now this happens at the end of a price pattern, signaling a new trend. Third one is a continuation gap. Okay, happens middle of price, and then you'll see price just continue. I generally don't like the continuation gap because I'd prefer it to get filled. So yeah. Fourth one, exhaustion gap, happens near the end of a price pattern. Okay, so I prefer more of you get a gap and that gap gets filled and then carry on. Why I'm telling you about gaps is you can use gaps to your advantage. When a gap occurs, okay, 90 to 99% of the time that gap gets filled. So if price is pushing up and a gap happens, and let's say price carries on going up, price will eventually come down to fill that gap, and then it will continue going up. So, you can use gaps as entry points, take profit, stop loss, just like support and resistance basically. Okay, you can use gap as the same sort of thing. So as you can see there, a gap happened between those two candles, and price pushed a little bit up, and then price retraced back down, filled that gap. Okay, all that liquidity is filled now, and price continued going up. So you know gaps will most likely get filled. You wait for the retest, put your Fibonacci, put your market structure, you wait for a candlestick confirmation, and then boom, you enter. So that's how you can use gaps to your advantage. Next one is slippages. Now slippage, as you can see, you place a sell order at that low of that candlestick, okay, and then your price is filled there all the way at the bottom. So when you place the sell, let's say at 1.32222, okay, but when you enter the trade, it entered at 1.3, I don't know, 1050, for example. Okay, that's because your order would be filled at the next available price. Now, slippage happens when you trade. Your trade is not filled at the price you opened, like I just explained. Now, the pure definition is that it is the difference between your expected fill price. So remember, you expected that price above, and then when you entered, it's the actual, fill price. It happens, but it doesn't happen often. It isn't bad because any difference between the actual price and what you've entered is known as slippage. The market does fluctuate quick, so the delay, also internet connection, sometimes it's unstable, so some people don't have the best internet connection, so just a little price change is slippage. It happens, so it's not that big of a deal. It's not as major as a gap. Generally happens during high volatility, so during major news events, just like gaps. And then if you want to avoid it, place limit orders instead of market executions, because with limit orders or pending orders, you will get filled at that exact price. All right, so here are three types of slippages with examples. So let's say you analyze the pair GBP USD and you want to buy at the price 1.32900. So you click the buy button, and your order is then sent to your broker electronically. Once your broker receives that order, they check if you have enough cap. Now remember, this all happens in a matter of a millisecond. Okay, so your broker will check if your account has enough capital to then open the trade. With other steps involved, it creates a delay. Now, so the time that you click the buy to your broker, eventually opening your trade, there might be a change in price, especially if the market is very volatile. Because like I said, they have to check this, they have to check that, then they have to enter for you. So if the market's very volatile, fluctuating so aggressively, of course it's gonna enter at a different price. Okay, so three outcomes can happen. There can be no slippage. No slippage is when the order placed, the best price is available. So if you bought GBP USD at that initial price of 1.32900, the trade will be placed at 1.32900. Okay, then you get positive slippage. So this is where, you know, the best price was opened. So if you place a buy at 1.32900, and let's say the trade opens at 1.32870, 3 pips below what you initially wanted to enter at, that means you got a better price. You got a lower price to buy at. Remember, you want to buy high, sell low. So you enter at a lower price. So you'll get a little bit more profit. And then obviously negative slippage. So when the order, okay, so you place 1.32900, but then the initial price then enters at, you know, higher, let's say 1.32950, 5 pips above, so you lost out a bit more. So those are the 3 examples of slippages.